Let's talk markets now with Barry Knapp, Managing Partner and Director of Research at Ironsides Macroeconomics. Barry, you've sort of been in the camp that the Fed's done enough, I think, in the past, and it doesn't look like they have at this point. Has any of the data caused you to question your prior stance, or do you think that the highs are in, should be in, and that the economy's slowing and inflation is actually coming down and no more needs to be done? You still feel that way?
I do from an inflation perspective. We're going to be just a little above 3 after we get the June CPI report in a couple of weeks' time. And then it's going to level out. And the problem that will make it likely not fall much below 3 is really fiscally driven inflation as opposed to monetary. The history of the Fed trying to offset fiscal policy really is the 70s and stagflation. So, I don't think they can really do all that much more about that. There's a couple of subtle points here, though, too. One is, from my perspective and from an investor's perspective, we're in a recession. We've had 2 negative quarters of gross domestic income. Income's really what matters. It's being driven by, this is BEA speak for corporate profits, but it's being driven by the net operating surplus of private enterprises, right? So profits have actually been negative by that measure for 3 quarters in a row. The question is whether we're coming out of the profits recession. There's evidence that we are, that earnings net revisions are getting better. But so for me, the really question is, do we have a double dip? Does the Fed cause a credit contraction? And what I think is important about what you all have been talking about is this deep inversion of the yield curve. And Mike just saying, Santoli, that is, just saying that the rates aren't high enough to really cool housing off. Now, the builders are a little misleading because small builders are getting hurt by credit availability. Large builders are benefiting. But the way that the Fed has done the tightening process, has conducted it with passive QT and aggressive rate hikes, means that those 10-year rates that really are the determining factor for the housing market haven't moved since September. Sure, they sold off or came down, but they're no higher than they were. They keep jacking up the short-term rate, which has no bearing on the housing market whatsoever. Were they more aggressive with QT and a little less aggressive with the front-end rate hikes, they'd be having a much bigger impact on those, durable goods like autos, housing, and the interest-sensitive parts of the economy. So this has been all wrong from the get-go, and the Fed remains the main problem here, because the deeper that curve inversion goes, the more risk we have of credit tightening, particularly for small banks and the small business sector. So
pretty interesting. You sound like you're describing almost the reverse of pushing on a string when they're coming down. They're trying to get rates higher. They can only work on the short end. The long end's not cooperating, so all the things they're trying to slow aren't responding to what they're trying to do. So credit tightens on the short end, but it still looks like we're in this rip-roaring sort of economy. I mean, is anything... I started by asking if your resolve has been shaken. I mean, you saw car sales 13%. You see every time we get a jobs report, it seems like it's hotter or better than expected. None of those things make you think that the economy is just right now so resilient that maybe some more tightening is warranted, because they're not looking at what you're looking at, Barry. They're not looking at the profit recession or anything else. They almost to a member, they all seem like they're absolutely certain that they need to get tighter to get inflation back down to 2%.
Yeah, it's fascinating because Powell's inflation framework that he laid out at the end of November at the Brookings Institute was almost defunct from the moment that it came out of his mouth. And, he was talking about wage growth pushing core services inflation up. Well, that core service inflation has been coming down. No one seems to push him on that topic, but, it's come down on a 6-month annualized basis from 9.5 to 3. The demand for labor has softened a lot, as measured by the work week being at the lows the entire last business cycle, wages having dropped by 1% since that speech was given. So total labor income is softening a lot. The only thing going up is that headline payroll report. I think the Wall Street Journal article earlier this week did a pretty good job with that. there's flaws in the birth-death model. I think they're missing business destruction. By the way, just as an anecdote, we're going to get claims at 8:30. We had a 230 to 240 range for claims, initial claims for 3 months. It jumped to over 260 for 3 weeks in a row. Last week, it fell to 237, I think. The market got really excited. Two-year note yields jumped 15 basis points. That was the week of the Juneteenth holiday. It's a new holiday. It's not in the seasonal adjustment factors. If you use the same seasonal as back in Memorial Day, it would have been 275. So I still think the labor market's weakening, and I think the Fed's done too much.